Slightly late start, folks. I apologize. That's more on me. I've been back to back on calls. I am quite excited for this conversation with Larry McDonald, who I've had on Spaces in the past. First time he and I are actually doing one of these visually, face to face. I just put out a post, something along the lines of the bond market's in a crisis and seemingly nobody gives a shit. We're going to be talking about potential for a bond market crisis, which may be underway, and how serious it could get, as well as post-election trades. Now, this is live streaming, so what that means is that if you are watching this across my accounts or Larry's accounts on X, YouTube, any of those various platforms, LinkedIn, we can see your comments, we can see your posts. So let's make this interactive. If you want to ask any questions, if you have comments, post on whatever platform you're watching this on live, and we'll try and bring it up and make this, like I said, as interactive as possible. This will be an edited podcast under Lead Lag Live on all of your favorite platforms, Spotify, YouTube, Apple Podcasts. Please help me keep the momentum there going. Top 5% by old-time downloads across all podcasts. And hopefully Larry's going to get me to the top 4%. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the roughly 40-minute time period here is Mr. Larry McDonald, convert bond himself. Larry, I know we've done this before, but there's always a new audience watching. So for those who are not familiar with you, who are you, what's your background, what have you done throughout your career, what do you do now?
Well, I started off kind of on the retail side of the business in the 90s. I was fortunate enough to sell our internet company, convertbond.com, to Morgan Stanley in October of 99. So we were very fortunate with the timing. And then I kind of built a convertible securities business at Morgan Stanley. I went to Lehman. I was a trader there. I ran a pretty successful, what we call proprietary trading business. Part of a group of guys, team that ran about $2 billion. And I was probably one of the more profitable in that period. I was probably the top 5 most profitable traders at Lehman in that group, in that high yield converts distressed business. And then in 2009, we published A Colossal Failure of Common Sense, the inside story of Lehman Brothers. And I teamed up with some key executives within the bank, and we wrote a New York Times bestseller that's been published in 12 languages. It's a great book that anybody can read. It's so readable. It's such a beautiful book, and it's in the top 20 all time at the CFA Institute, which we're really proud of. We were in the movie Inside Job. Was featured there with Bill Ackman and everybody else, and Matt Damon. That won the Academy Award. We were featured in there with our book. And our latest book, How to Listen When Markets Speak, has been a bestseller on Amazon all year. Came out in March, and it really focuses on what's happening now in the bond market, the election, and the beast inside the market that's starting to make some noise.
How to listen when markets speak. Do all markets speak in the same way with the same loudness? I feel like we have to define markets here.
Well, that's the key. Is like you have to look at. We run a Bloomberg chat, so for the last 10 years, we work with hedge funds, pension funds, mutual funds, high net worth individuals on the Bloomberg chat and also in our research platform. And we owe so much to them. So you want to be listening to people in Eurodollars, in feel like if say futures, SOFR futures, high yield bonds, equity volatility. You want to look at the whole basket of things. You want to look at positioning. You want to look at issuance sizes in the treasury market. One of the things that blows a lot of professional investors have been blown away by what Yellen did last year. Was a very clever thing, but a very dangerous thing, because normally a Treasury secretary will try to issue a balanced portfolio of debt securities, but they wanted to take a lot of bond volatility and place it into 2025 after the election. And so they issued a ton of T-bills, and T-bills don't move because they mature within 1 year. So when you want to how to listen when markets speak, you want to look at bond volatility, you want to look at issuance sizes. And because the US Treasury, I think quite irresponsibly and recklessly issued 2 standard deviations more T-bills than any Treasury secretary in the history of the United States, these securities, they have low volatility because they mature within 1 year or so, and that kept bond volatility out of the market over in an election year, which is very important. But now the next Treasury Secretary is going to have to term that debt out and issue 10-year bonds, a lot more 10 years, a lot more 5 years, a lot more 30s. And those types of bonds, Michael, they move violently. So if you imagine $2 trillion, if you had that $2 trillion of bond issuance in the market all of 2024, you would have had a much more volatile year. And Treasury didn't want that. They wanted the best setup for the Biden Harris team. And lo and behold, now we have to pay the price. And the next Treasury Secretary is going to have to try to somehow, threaten tariffs to the world, which are inflationary, at the same time, issue lot more longer dated paper. And that's, I think we're heading for a Liz Truss moment here in the United States sometime in the next 3 months.
All right, so that's actually a pretty big statement. First of all, has there ever been a time in history where there was that degree of micromanagement on the duration issuance end of things? I mean, there are a lot of people that will argue that there's been outright manipulation by Yellen. It sounds like you're in that camp.
Oh, yeah. We've never seen anything like this. I mean, this is just essentially the United States of America, which is supposedly the free leader of the world, right? We got $15 trillion of bonds. Half of our debt matures into 24, 25, and 26. That is insane and reckless. It's 15 trillion bucks. And the average weighted coupon on that debt is 2.6%. And if you just look on your screen right now, okay, where are 5-year treasuries? You're at 4.31%, right? So if your average weighted coupon on the 35 trillion is 2.6, your interest on the debt is 1.1 trillion now. And as that 15 trillion resets in the first 2 years of the Trump administration, that's going to reset at higher coupons. So your average weighted coupon is going to go to 3.5 maybe. And that's going to basically push the interest on the debt from 1.1 trillion to potentially 1.5. So the Fed had to cut rates 75. There's a reason why, Michael, the Federal Reserve cut interest rates, right? 75 basis points with the Atlanta Fed GDP, basically hanging around 3%. I mean, that is just, and, with full employment essentially, and they had to do it because there's a dirty, dark secret they really don't want many people to know. And we talk about it through the book, How to Listen When Markets Speak.
If you were to have that Liz Truss moment, I'm not gonna lie, that sounds pretty cataclysmic. Because unlike the UK, we're the reserve currency. I mean, aren't the implications of that far deeper than people might realize?
Well, what they're trying to do is offset that with these tariff threats, right? So the tariff threats would bring in a ton of revenue. And Scott Bessent, God bless him, brilliant guy. He is now supposed to be in that Trump Treasury team. But when you talk to hedge funds around the world the last 3-4 weeks, Scott and his team have been talking to people, investors all around the world. And when you look at this parabolic move in the dollar, I think the incoming Treasury team's kind of been tipping their hand because they want people to know that there's a ton of tax revenue that's going to come from these tariffs, which is good. The problem is a strong dollar is just look at Microsoft and Apple. More than 60% of their revenues, like close to 350 billion bucks of revenues between those two companies, is outside the United States. So a strong dollar is a wrecking ball for a lot of U.S. companies. And so that was one thing. If you look at the underperformance of Microsoft versus the market, it's something we haven't seen probably in 10 years, I don't think. And so we're talking about the recent Microsoft underperformance. If you look at the underperformance of Apple, very strange. So companies that have that high amount of sales outside the United States are kind of threatened by this first move of the Trump team.
I've been making it a point to advisors that, to the extent that Trump is perhaps harsher on tech companies, just because of the free speech side of things or the social media end, that might be enough to cause a broader rotation into other sectors like financials, right? And maybe even a style shift from growth to value. Am I crazy in thinking that we might be in the midst of a like almost tectonic shift in sector leadership?
That's the key driving thesis of our book. And if you look at the industrials versus since July, if you look at the industrials, and don't look at the Dow's not even industrials now. There's a Salesforce, Microsoft, Apple, Nvidia. I mean, there's just it's a fake industrial index. If you look at I think it's the VIS, which is the Vanguard Industrials Index, which is a much more robust industrials index. If you look at that versus the Qs, and you look at, say, a 3 or 4 or 5 year chart, if you can reach out to our team, Valentina at the Bear Traps report, we can share you the report. But essentially, that's her email. But essentially, you're seeing a real big move in the industrials versus the Qs, and that's the type of those types of companies would, we think, perform much better in a higher interest rate regime, a higher yield regime. And what I said before is, I just want to make it clear, if you have $300 or $400 billion of sales outside the United States, and the dollar goes up in a very short period of time, that's going to really hit those products of Microsoft and Apple are going to be a lot more expensive with that strong dollar, and that's what potentially impacts, like I said, about $7 trillion of U.S. equity market valuation is in just those two companies, and they're very, very much exposed to the market and to the dollar.
What's it going to take to break the dollar? I mean, so literally 3 months ago, everyone was suddenly saying we're in a secular downturn on the dollar. I was actually myself arguing that no, I think actually now you're probably going to bounce pretty hard. What can possibly make the dollar weaker at this point? You've had this dynamic for now over a decade.
Well, what's going to happen is they're going to threaten countries with the tariffs. This has been out there. Like I said, Scott Bessent and his team, they've been meeting with hedge funds. So this dollar move, I think the pain is about 50, 60, maybe 70% priced in, because this election is just like 1980. The market was pricing in, just look at the financials, look at the carry, it was up 40% into the election. Look at the XLF, up, huge into the election. I could point to, look at private prisons, look at Fannie and Freddie. We were saying this on Twitter, and this is election. It's just like 1980, where in 1980, the S&P was up 45% in that year, into the election, year over year, from October of the previous year of 1979 to 1980. We're up 45, 46%. So the market was pricing in those, tax cuts from Reagan, that deregulation, right? And the beast in the market knows people listen when markets are speaking. And that's part of the key driver of the book here. And so what's interesting is the market ran up aggressively into, Reagan was the ultimate free market, market-friendly candidate, literally of all time. Like, you could just say Trump is number 2. Reagan was that market-friendly. And so the beast in the market drove equities up almost 50% into the 1980 election. And then on November 19th, 1980, the equities topped out because Reagan wanted to take the pain. The Reagan team needed to take the pain, because by the midterms and by the next election, they wanted to set up a better situation. So always remember, when you have a situation like this, where a lot of goodwill is priced in, the incoming administration will most likely take the pain on a lot of things, do the hard things early and fast, things that aren't that popular, take the pain. And then by the midterms, remember, Trump lost the midterms in a big way in 2018. He got sandbagged in a lot of ways by they moved Obama, McConnell and Ryan, through reconciliation, convinced the White House to move Obamacare reform ahead of all of Trump's wall stuff and tax cuts. And it was a disaster for Trump in the midterms. And he lost a lot of states. And lo and behold, he was impeached twice. And so Trump knows this time. The Trump team has literally been preparing for this presidency for 6 months, whereas the previous Trump team was caught flat-footed in 2016 when they came in. So that's just a lot more going on behind the scenes this time around.
There's been a lot of obviously big market movement, post-Trump. I'm curious, just as you've been observing various asset classes, what parts of the marketplace do you think are, in quotes, getting it right about a Trump administration versus getting it wrong? I mean, personally, I get the sense that, and this is not because I'm a crypto hater by any means, that a lot of the excitement around, pro crypto and deregulation, that may not be anywhere near as close to reality as the price movements would have you think. But what's your take on things?
Well, I just have to finish that dollar and then I'll get the dollar. I think the dollar is mispriced now, for example. But you asked like, what could stop the dollar? So essentially, by promising these tariff threats aggressively and choreographing that and making it very well known, the agenda, the dollar rips. That that dollar ripping with the tariff threats, especially those tariff threats, cause if you're a big Costco, a Walmart, any kind of big importer, you're gonna basically front run the tariffs the best you can and import as many goods as you can from around the world. And so let's say Trump comes in office in January, the tariffs are in effect in the middle of the year. A lot of these importers are going to aggressively front run that. And that's going to cause a bounce in inflation. And so there's a lot of things going on already because of the Biden team spent about almost $2 trillion into the election, fiscal overdosing. And so you have 75 bips of rate cuts, you have a China stimulus. So the probability, because of these tariff threats, that you get a big shock on inflation, like a half of, say, what happened in 22, which would be a big shock. That if that keeps rates up, then it's going to force the Fed to stop in and protect the bond market at some point, and that gets you a weaker dollar, right? So it's tariffs versus what the Fed might get forced into. If the Fed is forced to come in with QE or come in with some type of protection for the bond market because bond yields, the beast in the market is forcing. And remember that marginal buyer globally, and we talk about this in the book, How to Listen When Markets Speak. When you take that sanctions weapon and pound it over the head of emerging market countries for 15 years, Democrats and Republicans, it's the most ignorant, hubris, abuse of power that comes with a price. It's not free, okay? And of course, the Biden team using those aggressive sanctions against Russia, God bless them. But the problem was all the previous administrations had overused the sanctions weapon. And so now you have emerging market countries all around the world that are not buying as many treasuries, and Powell's going to get forced to step in and clean up the mess. And it's all coming at us in the next 3 to 6 months. And that's what gets you the weaker dollar.
Saving the bond market implies obviously saving the government bond market. I'm curious to hear about corporate credit from your perspective. So here's the challenge, right? If they save treasuries, can they save junk, right? Because those have been unbelievably strong throughout this fastest rate hike cycle in history, much to my chagrin, because I'd love to see spreads blow out because that brings opportunity. But what happens on the corporate credit side under that scenario?
So corporate balance sheets are in better shape by and large overall. And a lot of the leverage in the world since Lehman, one of the things I talked about in the first book, Colossal Failure of Common Sense, is all the leverage in the world was on the public balance sheets. It's on corporate balance sheets, household balance sheets. Now we've taken all this leverage and we've placed it on the Fed and government. It's on government balance sheets around the world. And if you look at the losses on the Fed balance sheet, they're daunting. And one of these days, Congress is going to start to look at those because interest rates up, bond prices down. The corporate bond market is still benefiting from imagine thousands of veteran investors in fixed income that for 10, 15 years the Fed had suppressed interest rates. So they had no coupons to buy. It was a torturous experience for anybody in corporate fixed income. And so on the buy side. And so as interest rates have gone up, always remember break evens. The rule is 72. If you get 6% a coupon, your money doubles every 12 years, right? And so it doesn't take much with higher coupons. Higher coupons protect bondholders in a way because the rule is 72, 6% on your money is doubling in 12 years. 8%, far less. And so if there's coupons out there at 9%, your money's doubling in a very short period of time. And so your break evens, and that's what's been supporting that, plus the massive fiscal overdose. I mean, colossal. You're not going to have a bond market blow up in corporates with $2 trillion like deficits of 1.6 and 2 trillion back to back. It's next to impossible. And so that, if there's any kind of cut in government spending, that's what's going to start to blow up the corporate bond market. Or if rates really start to move, that's when the government bond market starts to crowd out the corporate bond market. And that's, looking at the screens today, we're up another 12 bips on 10. So yeah, we're at the point now where the bond market, if we go higher in 10s, higher in 5s, higher in 30s, starts to crowd out the corporate side a little bit more, and that presents a threat.
At what point is it a time to buy duration? Because I think this is sort of the real, in some ways, the only question that matters. It seemed like the Fed cutting rates was going to spark that cycle, and the exact opposite reaction started to take place post Fed cut. I mean, I have said, and I've been wrong in saying this, or maybe early by 2 years, I said they will save the bond market by crashing stocks, because historically, not my opinion, you look at the top 1% biggest declines for the S&P 500, yields fall, just flat out. That's the flight to safety kind of risk off trade where it goes into treasuries duration wise. Is that what it's going to take to stabilize treasuries outside of QE, a more market driven type of panic?
Well, what's the perfect answer to that is August 5th. So that was the largest spike in the VIX since Volmageddon of 2018. It didn't last long, but
and by the way, largest spike in the number of impressions on my account because of the reverse carry trade, which I was right on for about 2 trading days, and everyone's like, "Oh, you got it right."
I know you were ahead on. You were out there, and you were listening to market speaking, because the yen and the Mexican peso. There was a lot of things telling you that thing was about to pop, but it's tricky because they were kind of out there for maybe 3 or 4 or 5 weeks, and that trade was so hard to diagnose. And I commend you for getting out front of that. But when it comes to rates and breaking things, and then we're getting back to August 5th, the 30s never, like during that entire sell-off, which it wasn't long, but it was a high vol moment. 30s, I don't think ever broke 4%. And so there's something out there in the market on the long end, because the market knows that the next Treasury Secretary has to term the debt out. I don't think you see a real bottom in bonds until the first quarter, but then it's going to be a Hall of Fame back up. I mean, we were buyers of the TLT and our trade alerts at the Bear Traps report and the ZROZ late 22 and last year. It was painful. We were wrong for a little while, but eventually we had that nice bond rally as the economy softened there in 22, and now we have a much bigger issuance problem. But yeah, I will be looking for that moment. I think it's probably happened sometime in the first quarter next year. We will get that bottom and longer duration, where we can really step in and buy duration.
Let's go back to sectors. I think there's a lot of hope that maybe a Trump administration is going to be really positive for commodities, for oil, energy in particular. Any thoughts on that? Because it seems like oil is really not quite sure what to make of what comes next.
Okay, so in the last like, I'm exhausted. I mean, I had to cancel our last get together because I've been on the road trying to spend time with the family. But because of the book, we did speeches in Zurich, New York, and these are roundtable dinners. So you do the speech, and then you do what we call the ideas dinners with the hedge funds, pension funds, and mutual funds. And so we were in Zurich, Geneva, New York, and last week Dallas. In Dallas last week, what I find interesting is when I hear this from 2 to 3. Right now, I've heard it in the last 3 weeks from 2 to 3 really impressive people in the energy space that I trust, that I've known for a long time. And their point is that the Biden team forced Bibi and Israel to really calm down the retaliation and not hit the energy assets. But when you talk to people like ACG Analytics, our partner in Washington, they've done some great calls, David Metzner, on Israel. And when you talk to people over there that are close with the government, they just feel that those 550 missiles that have hit the Iron Dome in the last year are financed by oil. And so Trump can sanction the oil, or he can let Bibi hit it. And there's been 3 or 4 different phone calls with Netanyahu's team and Trump over the last 2 weeks. And when I talk to veteran investors in that space, they think that, with high conviction, they think the market's not priced for this, because the probability that you get some type of an attack on those oil facilities in Iran is more than 50%. And I was more certain of it before, but I'm still pretty certain, because the more I talk to these people, that's very bullish. The other thing, I talked to a client on Sunday, billionaire investor. He made a point that a couple of people have been making to me over the last 3 months, 6 months. Team Biden was so terrified of oil. Now, if you think of inflation in, say, 2022, 8, 9%. Team Biden, after promising Americans that they were going to kill shale and all this stuff and really be the enemy, and the first couple of executive orders were actually, very hostile to the energy industry of the Biden administration, Biden team did something brilliant, and they opened up permitting violently, and they got U.S. production up as fast as they possibly could. And that, really almost saved them, because if oil had been a little higher, it would have been a real landslide. I mean, because you think about where inflation is now, and if oil had stayed sticky the way, it stayed up there, you would have had a much bigger inflation problem. But Team Biden opened up permitting. And so what institutional investors that are close to the Trump team, close to the Biden team, but they're most important, they're very, very experienced in the energy patch. They don't think it's going to be hard for Trump to really get production up fast. He will get it up over 4 years, no question about it. But a lot of that low-hanging fruit, don't forget, energy companies. If you're a CFO at an energy company, and you just watch your previous 4 or 5 bosses get fired, right? Oil and gas, all this is just, the CapEx discipline is off the charts. So the massive underinvestment, we talk about it in the book. And so there's 1 billion people in India that don't have air conditioning. There's just so much energy demand out there, but we've suppressed the capital investments needed to supply energy to the world. And we still have a big supply problem. We have a big geopolitical problem. So I'm very bullish energy here. You can buy Oxy. Think Buffett. Buffett bought 240 million shares of Occidental Petroleum. The last 80 million shares, he bought at a higher level than where it is today. Schlumberger is making, I think, earnings power of Schlumberger is the same as it was in 2013-14, and oil's a lot lower, right? So you can buy, if Trump goes back to drill baby drill, companies like Schlumberger could be doubles from here. And once again, there's $23 trillion in the NASDAQ 100, 23 trillion bucks. 10 years ago, there was 4 trillion in the NASDAQ. 10 years ago today, there was 4 trillion in the NASDAQ 100. Energy was about a little bit more than 3 trillion. So think of 4 versus, say, 3.4. NASDAQ 100, 4 trillion, energy 3.4. Today, you're 23 and a half trillion in the NASDAQ 100, and energy is still 3 trillion. So net, there's a lot of gains out there in tech that we feel, with the highest conviction, and this is one of the main thesis points in the book, we're going to have a big move out of tech. We're already starting to see it. There's $1 trillion has already left the NASDAQ 100, even though stocks are making all-time highs in the last couple months. So 1 trillion's left since July. We think 6 or 7 trillion leaves, and that's one of the greatest migrations of capital ever. And that puts a lot of capital into energy, into metals companies, into hard asset companies. Never forget, 1980-81, at the end of that inflation regime, 49% of the S&P 500's composition was energy, industrials, and materials. 49%. In the last year, that's gotten down to 12. And so you want to be long industrials, you want to be long energy, long materials, and you want to be underweight, the crowded trades.
I don't think gold is a crowded trade, so I think we should address that because somebody's asking on X. Hi, Lawrence. Thoughts on gold, please? A bit of a sell-off more recently, short term, but what's your thesis on gold?
Okay, so real rates didn't matter for a while because bond yields came down and inflation came down. Over the last month, because of the threats of the election and the uncertainty around Trump, real rates have really moved up a lot. And if you can get, right now on a 5-year treasury, you can get like close to 4.3%. That 4.3% is, can you hear me?
Yeah, you're good.
Okay. Did I cut out there?
Yeah, momentarily, yeah.
Okay, sorry. Yeah, the bottom line is that the front end is, if inflation is not ripping and the front end is staying up there at 4.3, it's going to suck money out of gold. Gold's going to need right now front end rates to come down, and as Powell started cutting, gold ripped, right? But front end rates have now backed up even after the cuts. And so especially right now, twos just made a local high, fives just made a local high, and I think tens are making a local high. So that's just, unless inflation really starts to rip, that's going to suck money out of gold. But once again, this all comes down to the dollar. It all comes down to Powell. He's got to cut rates. If rates are up this high, interest as a percentage of tax receipts is close to 23, 24, right now, I guess 21 to 25%. And if interest rates stay up here, and as I showed you, the average weighted coupon is 2.6, it goes up to 3.5, then your interest as a percentage of tax receipts goes up to like 40%. And that's where Powell has to come in. So gold, that's where gold's. So you got to buy the dips in the gold miners. The gold miners are cheap to gold. You got to buy the dips in gold, silver miners right here. And we've been doing that over the last couple of years, and we've done pretty well with some of those purchases for clients in our trade alerts.
It's a good transition since we're coming up to the top of the hour to talk about the trade alerts, talk about some of the things that you do, and maybe just do another plug for the book and where people can find you.
Well, on Twitter at ConvertBond, Valentina at thebeartrapsreport.com. We send you our latest turning point in our mill. But basically, what we try to do is work with institutional investors around the world. That's how we created this book. We worked with a lot of the big hedge funds, mutual funds, and pension funds. This book is about democratizing information. Same thing with the Bear Traps Report. And most of our clients are on the institutional side, but we create products for all investors, really, from family offices to financial advisors. We've got almost 1,000 financial advisors that are clients in the Bear Traps Report because they just don't trust their in-house research, if you know what I mean.
Yeah. Well, it's good to get that diversification of thought. Any final parting words here? I mean, I don't want people to kind of walk away and suddenly think, "Oh my God, the world is ending." Although a lot of people will accuse me of being like that on my
No, I'd like it. So Neil Ferguson did the forward of my. I mean, Neil Ferguson is just a Hall of Fame historian, one of the smartest political economic historians, the smartest political economic historian ever. But Harvard Hall of Famer, and he's got a number of best-selling books. But he wrote the forward for this book, and he said, "Listen, this is not a gloom and doom book. This is just like a reposition your portfolio. Everyone's long the 2010 to 2020 portfolio. Everyone's long the same thing." And so we're starting to see this big shift, and we saw it in gold this year, we saw it in silver this year, we've seen it in some of the copper plays, we've seen it in SMRs and uranium names. There's a migration moving from financial assets, which are bonds and tech stocks and growth stocks, to when you come into a higher interest rate regime, or a higher, when inflation normalizes at a higher trajectory, that creates a 1968 to 81 portfolio where you want to be long a totally different group of stocks.
Everybody, please make sure you follow Larry McDonald. I apologize for being late on this initial conversation, but we'll do another podcast soon with Larry. And make sure you check out his various work, and of course buy the book, and be honest with the review when you read it, which means, of course, give it 5 stars. Thank you, Larry. Appreciate it.
Thanks, Michael. Thanks, everyone.
Cheers, everybody.
Okay.